Hola, econ peeps. Let's go ahead and knock out our very last module. I will pause for applause. All right, here we go. We're talking about exchange rates. Remember, exchange rates. All right, this is the how much dollars it takes to equivalent amount of pesos, or the euro, or yen, Canadian dollars, whatever it might be. All right, there's an exchange rate. Okay, it's the price of one currency expressed in terms of another. Okay, we're going to talk about strong dollar, weak dollar, or really strong currency or weak currency. We're going to talk about the implications of fluctuations in the exchange rate. All right. Most countries have their own currency. Not necessarily everybody, but most do. Some smaller economies will borrow the currency of their larger neighbor. Ecuador, El Salvador, and Panama all use U.S. dollar. Dollarize means to use the U.S. dollars as their currency. Sometimes nations share a common currency, such as the euro, although the euro is not a nation. It's the currency. The market where people go to exchange one currency for another is called the foreign exchange market, or Forex, as you've heard me say. Remember, Forex is what is affecting our fourth macro, or our fourth factor in output, aggregate demand, that kind of thing. It's that fourth one. Consumer spending, government spending is fiscal policy. Business spending is monetary policy. Net exports is foreign exchange. Okay, primarily there's some overlap. If you had a Venn diagram, you would definitely have them overlapping. Okay, but you get the idea. Okay. Every exchange rate is a price. Duh. All right. So you can see that the dollar is easily the largest traded currency on the market. Okay. It's not insignificant. Now, this was in 2016. I don't think it's changed that much. I really don't. If anything, it's probably gone up because the dollar's a lot stronger than many of the global currencies right now. So what drives demand for the dollars? Anything that again, foreign consumers or investors cannot put their currency in our banks. They cannot buy our stuff with their money. If they come here, they have to have our money. Okay? So, what drives demand for dollars? Our export firms. Our export firms are trying to convert the foreign currency they've earned from other countries buying their goods. They've got to convert that back to U.S. dollar. Okay, foreign tourists, they may come over to visit various places, vacation here in America. They would need to convert their currency into U.S. dollars. Hardly anywhere. Maybe some places in New York, some of the really larger places that see a large influx of foreign visitors, they may be some places that will take other currency. But generally speaking, here in America, it's pretty much just the old-fashioned dollar. Because, this is America. Foreign investors, if they want to buy land, if they want to buy our stock, it's all, they're free to do that. But that does require they get the dollar. So what's driving demand for the dollar? Our exporters who need to convert the currency they got when they sold their goods to foreign consumers or nations. Tourists coming over to vacation or spend some time here in America. And foreign investors who are looking for places to put their money. Okay, they can't put it in our banks. They can't buy our stock. They have to convert it to dollars. Okay, what drives supply in the foreign exchange market and Forex? Well, foreign firms that have sold imports in the U.S. economy, we bought those in dollars, but we have to they have to get that converted, and in order to do that, we're supplying them with dollars. U.S. tourists abroad, they are supplying dollars. U.S. investors seeking to make investments in foreign economies. They're supplying the dollars, right? So you get some idea of how that's working. All right. Yeah, don't worry too much about this. We're not going to get, that bogged down into specific foreign financial investments. It's not necessary. So a couple of examples. An international investor who expects that in the future the British pound will buy $1.60 in currency instead of its current exchange rate of $1.50 may hope for the following to occur. 24,000 converted to 16,000 at an exchange rate of $1.50, which goes up to $1.60. They then come back and convert their 16,000 pounds back to dollars and earn a profit of about $1,000. An international investor expects that in the future the British pound will buy only $1.40. They may instead take that $20,000 in 20,000 pounds in British currency and convert it to $30,000 in U.S. currency. And then once the exchange rate changes, they will convert it back to pounds and earn a profit of 1,400 pounds. So that's just examples of how that works, right? And here's a nice breakdown. It's really useful, okay, I think, to give you, again, idea of what supply and demand, how that looks and works. We're about to do a graph of this, so you will need that. All right? Participants in the exchange rate market. Foreign exchange market does not involve the ultimate suppliers and demanders of foreign exchange literally seeking each other out. It works through financial institutions, and it operates at a number of levels. It's not like one single market, right? Obviously. I mean, what I mean is it's not just simply a separate market for each currency. The foreign exchange market is really little more than financial institutions who act as the sort of intermediaries making those conversions. And some banks specialize in that, right? Some banks specialize in these kinds of foreign exchange. All right. Yeah. That's good. Okay. So let's. All right. So here's to me the best way to illustrate how the foreign exchange market works. And I got this from another AP macro instructor because it can be difficult. But in this example, I'm going to use U.S. dollars and the euro. Okay, so this is euro per dollar, and this is the quantity, if you will, of dollars. And then that's a supply and demand. Same for euros. All right, this is what I have so far. Let me go ahead and give a big screen here. Get my big head over here. All right, so here's, I'm trying to see. Let's see. There we go. This is what I have. These are my two graphs. All right. So let's say we'll go with some people in England are coming over. You know, that's euro. So we'll say people in France coming over for a visit to America. Slumming to America, as they would say. All right? So they can't use their euro. So they are going to be demanding the dollar. They're going to supply the euros and convert that to dollars. So they're supplying euros and demanding dollars. Okay? That means the demand for dollars is going to go up. And the supply of euros is going to go up in this foreign exchange market. All right? Now, I should say the initial place where the supply and demand curve intersect, that is, right, I'm centered well, that is the exchange rate, E star, if you will, right? And so now with the demand, they provided they supplied the euros and demanded the dollars. So now that's going to cause, relative to the euro, that's going to cause the value of the dollar relative to the euro to increase, while the value of the euro relative to the dollar is going to decrease. Okay? There you go. Now, there's a name for this. So the dollar appreciated and the euro depreciated. Now, you could do the opposite. We could say the Americans went over to France for a visit, right? In that case, they would be supplying the dollar and demanding the euro. But you'll notice what happens. One uses one curve, the other one uses the other curve, and the curves move in the same direction. Demand increased, supply increased. That's how you get this. Listen, a currency cannot appreciate relative to the other currency without that other currency depreciating relative to it. That's not possible. If one's appreciating, the other one is by definition depreciating. Okay? Every time. How do you facilitate that? By being sure that when you make the transit, whatever it is you're plotting out here, that you're sure that the curves move in the same direction. Both the supply and the demand curve increased, but it was two different curves. And that's why you have this alternating up-down. That's what you have to have. One appreciated, one depreciated. Every time, no matter what. Okay? And this is important. How does this affect aggregate demand? How does this affect output? Well, when the dollar appreciates relative to some other currency, our goods just got more expensive relative to their goods. Law of demand applies everywhere. It's a universal phenomenon. If our goods just got more expensive, guess what? Foreign consumers are going to, if the price of our goods goes up, then the quantity of our exports demanded is coming down. Right? Similarly, we're not going to like our more expensive stuff either. All right? And that means we're going to be consuming more of those imports. So the quantity of our domestically produced goods is the quantity of domestically produced goods demanded will decrease, will fall. So says the law of demand. That being the case, you now have exports that are coming down and imports that are going up. We're buying less of our stuff, buying more of their stuff. They're buying less of our stuff, they're buying more of their own stuff. Right? So net exports is X minus M, remember. Here that is, right? Our fundamental equation of macroeconomics. And if we are exporting less and importing more, then we are subtracting a larger number from a smaller number. We are subtracting a larger number from a smaller number. When you do that, guess what? Net exports get smaller. Or in this case, in our case, it becomes, can I say more negative? What's wrong with me? That's not what it, you know what I'm saying, right? It becomes a larger negative number. How's that? Right? It becomes an even larger drag on our economy, taking money out of our economy. All right? So, when the dollar appreciates relative to some other currency, that's what's going to happen. Now, in that other situation I described, where let's say American tourists go to France, they're going to demand the euro and supply the dollar. And when they do, that means that the dollar is going to depreciate relative to the euro, and the euro is going to appreciate relative to the dollar. And then you have the opposite effect. When our currency depreciates relative to some other currency, in this case the euro, our goods get less expensive. Well, the quantity of less expensive goods demanded is going to increase. Foreign consumers want more, exports going up. Likewise, we're going to consume more of our domestically produced goods because they got less expensive relative to European goods. So the quantity of domestically produced goods is going up. That means we need less imports. Imports going down. And in that case, It is the bottom set of arrows, if you will. These two smaller ones right here and here. Sorry, running out of room on the page. But you get the idea. Now we're subtracting a smaller number from a larger number. Imports got smaller, exports got larger. We subtract imports from exports, and guess what? Now net exports is larger than it was. In our case, it's less negative. How's that? Less of a trade deficit. Maybe we even end up with a trade surplus. But you get the idea. Okay? I hope. All right. And that's the importance of appreciation, depreciation. When they talk about a strong or a weak dollar or some other currency, what they mean is it has appreciated relative to other currencies if it's strong. Weak currency has depreciated relative to other currencies. Okay? And notice this third bullet point is what I was saying. The appreciation or strengthening of one currency automatically means depreciation or weakening of the other. Every time. Got to. Some people like that. They want their currency to depreciate. China does it on purpose. We'll talk about that in a moment. All right. All right. So nothing too much here on this particular slide. So here's a table that kind of summarizes some of these effects. Right? So not a bad summary there. So let's see. And then here's this is pesos per dollar, and this is dollars per peso. Okay, right? So here's the dollar exchange rate. Here's peso exchange rate. I would assume they were going to, I was assuming they were going to show us an exchange here, but maybe that's coming. Well, maybe not. I mean, this is what they look like. Supply and demand curves. Ooh, pretty. So sometimes they think if you think the dollar is going to increase in value, you might go exchange some dollars now. That drives up for demand for dollar, and guess what? They go higher. There's a lot of speculation in the foreign exchange market. There's a lot of speculation related to this value of the currency. All right? And because of that speculation, it can have an effect on the supply and demand of the dollar. If they want, they can drive up demand, right? They can buy a bunch of dollars at the current exchange rate and drive up demand and cause the value of the dollar to improve relative to that other currency. They can sell it off and make a profit like we were describing before. All right. Yeah, I don't want to get too bogged down. There's 3 questions in my last unit, 4 questions in this one. So this only adds an additional 7 questions to the work that you did, with a 4 modules prior to this one. Total of 6 units in this one, if I'm not mistaken. 11, 12, 13, 14, 15, and 16, this last one. So those first 4, policy making, that's where a lot of this is. This is important too, but again, I don't want to get too bogged down in the global finance and stuff. If a country experiences relative high inflation compared to other countries, then the buying power of its currency is eroded, and that means that people are not going to necessarily want to hold your currency, right? So that might reduce demand. And dollar depreciates, etc., etc. All right. Arbitrage is this process of buying and selling goods across borders to take advantage of those price differences, right? So when their currency is weak, you might buy up some of their stuff, and when it improves, sell it back off. Or when the dollar is strong, maybe try to sell it here. Just depends on what's going on with the market. Purchasing power parity is this notion that we want the Big Mac you buy in England to be roughly equivalent in euros to what the Big Mac is here in dollars, right? That's purchasing power parity. Parity just means roughly equivalent, and purchasing power is a reference to how much of a Big Mac your money's going to buy. So we want that to be roughly equivalent in its own currency, right? That's the goal. to equalize these prices of internationally traded goods across all countries. That's what we want, but not everybody cooperates, and I'll explain why and how that works in a moment. As it says, movements in the exchange rate will affect quantity of aggregate demand. Listen, this is kind of a passive. It's not a policy-making tool in its own right, which is why it's not in that other. Which is why it's not. I don't in other classes I teach. I don't typically include it. I only did 3 units for y'all. Typically, I do 6 units, and policy making is its own unit. It would be 11, 12, 13, 14, and then 15, 16 is the last unit, unit 6. And the reason why it's usually in its own unit is because it's not really a tool for policy making. Listen, it can affect aggregate demand, don't get me wrong, but it's a little hard to control. It's not something we can do, usually. Now, we can buy and sell our currency. We can have some effect, but we operate under a flexible exchange rate system based on the supply and demand of the dollar relative to other currency. It's not something we have a whole lot of control. It's a fairly passive effect on aggregate demand. But the Fed watches it, the government's watching it, because it does have an effect. And if the dollar appreciates, if it's staying strong when we're experiencing inflationary pressure like we are right now, that can make it very difficult to get that inflationary pressure down, because the dollar's doing well. We don't want, we want to monitor that. We call it a flexible float, the flexible exchange rate system. Like I said, we can buy and sell, but we want to be careful because those fluctuations can really disrupt global trade. And of course, it can really result in trade imbalances. All right. So that's a big problem. Yeah. Not gonna do all of this here. Okay. All right. So floating exchange rates, that's typically what we are, where it's determined by the market forces. Then there's the soft exchange rate pegs, where the exchange rate is usually determined by the market, but the central bank sometimes intervenes. We are probably between those two, closer to floating, but we can intervene and occasionally buy and sell our own in order to affect and try to have a soft peg. And we just mean we want the dollar to be this much relative to these other currencies. That's a peg. We're going to peg the dollar to that value. It's easier said than done. And then there's the hard exchange rate pegs, where the central bank intervenes in the market to keep currency fixed. That's what China does. And China intentionally devalues their currency. When President Trump called them a currency manipulator, he wasn't lying. They are very much a currency manipulator. Why would the Chinese government want to keep its currency devalued? Because it keeps Chinese goods a lot less expensive than everybody else's stuff. It's just another way they have of trying to undermine other economies. Okay? Then there's the merging currency, where it's made identical to currency of another nation. They just peg it to that value, really. A lot of people peg their currency to the dollar. Floating exchange rate is set by the market. Yeah, we're a floating exchange rate, as are about, almost half of all the currencies. Soft peg is the name for an exchange rate policy where the government usually allows the exchange rate to be set by the market, but does intervene some. I think we do have a little bit of that. We don't do it very much. We don't need to. The dollar's strong. It's doing good. But sometimes. And then there's the hard peg, and that's what China does. China does a hard peg. It tells the world what its currency is valued at, and it always keeps it low, keeps it devalued. Now there's a trade-off to having the market determine our exchange rate. But nonetheless, I don't want to I don't want to wander too off. I don't want to wander off too far into tall grass here. I want to stay focused on basic foreign exchange dynamics and the foreign exchange market without wandering too much. And I feel like we've done a fairly good job. Don't worry about merge currency. All right, folks, that is it. You did it. You survived. Not all of your compatriots did, So, congratulations. I know it was hard. It's no fun. It's weird for me to talk to people I never see I never really have any interactions with, except occasionally by email. But that's okay. I don't mind. I hope the course met or exceeded your expectations. If it didn't, please let me know. Share any thoughts, suggestions. Don't feel bashful. If you're worried and don't want me to know it was you, feel free to create a fake email address at Yahoo or Hotmail, something like that. yousuck@yahoo.com is fine with me. Not going to hurt my feelings. I'm a grown man. I can take it. I'd rather have your feedback negative from a fake account that insults me than to not know at all what you thought of the course. And it's important that your thoughts about this course, trust me, I have made changes to my class based on feedback I get from students. We all do that. All right. And I am certainly open to suggestions. This was all new material that I'm using for the first time. Taught the class a lot. Never used this material before, and that's very awkward for me. To go into each lecture not knowing how it's going to present this. But I mean, I could have sat down and gone through the PowerPoint slides, I guess, but I just didn't have that time, folks. I'm teaching it. I'm pretty busy semester. So, nonetheless, I hope the class met or exceeded expectations. To the extent it didn't, please let me know. If it did, let me know. I would love to hear from you. Regardless, folks, have a wonderful break. Let's get ready for the final exam. We're almost there. We're almost done. We've got Thanksgiving and then final exam review, and then I will send you an email and let you know when the final exam will be. Okay? We'll figure out exactly how we're going to do that. And I got to meet with my department, and we'll figure that out. So, nonetheless, folks, been my pleasure. Thank you so much for letting me come into your world, these 16 modules, and speak to you about economics, a subject I have some passion for. It's been a real privilege of mine to be able to do that. And again, do let me know. Please provide me any feedback that you might have. As always, folks, be safe, be kind. Thanks.